It's Sunday, July 31st, 2022. This is all about your Benjamins and your weekly mixtape and weekend review video. And before we get to those headlines that may or may not be impacting your financial planning portfolio, I have to give a big happy birthday to Roman. Now, chances are he's not going to listen to this podcast. He's not going to watch it on YouTube. But today he turns 12, so I want to wish him a happy birthday. We spent the day yesterday at Topgolf with some friends. Today will be a little more laid back, family celebration, some basketball games, back to school stuff as the boys go back to school this week. But wanted to start it off with wishing him a happy birthday. Let him know I love him very much in case he watches this. And so happy birthday, Roman. All right, to the headlines that may or may not be impacting your financial planning portfolio. And if you're on the blog watching this, you can see there's a few headlines, a lot of similar topics, just some updates. There's one topic I want to go into a little bit deeper. A little bit more kind of a mindset, so it's not even going deep into the actual subject matter of the headline, but more about a way to view opportunity and to learn from those that have the wealth that so many of us want to aspire to have, or not want to aspire to have. So first and foremost, let's get through the updates first. Federal Reserve met last week. They raised interest rates again, 0.75% or 75 basis points, as you might hear in the news. Not unexpected. There was a little bit of wonder if they would do 1% since inflation was high again, although, as we talked about last week, showing maybe some signs of softening. Chairman Powell basically said, we're going to continue with raising rates, even though it shows that inflation might be slowing. It's still well above their target of 2%. Remember, we've talked about this for years. Their goal is to keep inflation around 2%. We're way above it right now. So they're going to continue to raise rates as we go to try to bring inflation down. Inflation's at a 40-year high. So expectation is we're going to continue to see the rates continue to go up. Will they continue to increase rates but increase them at a decreasing rate? That would be the next thing. So one of the things that happened that's kind of like you never know what the market's going to do. The Federal Reserve raises interest rates, which in some camps would be a bad thing. Cost of borrowing is more expensive. Interest rates we're going to be paying are going up. Businesses will make less money as they borrow to grow. So you think that can slow the economy. And that's one of the reasons we have the market being down this year is rising interest rates. Yet, the signaling is that the Federal Reserve is still doing everything they can to try to combat inflation. So this week, the market liked it. Next week, who knows what the market. So I bring this up only to show that we never know how the market and the participants in the market that control things are going to react. We could have gone into last week and said, all right, the Fed raises rates, that's bad because inflation's not getting better. It's going to make everything cost more. Mortgages are going to go up. That's going to slow real estate. The recession's going to be even deeper. So the market's going to sell off. Or what happened? We go into the Fed. They raise the rates. They're going to do what they need to do. They're not letting up too early. They're going to beat inflation, so the market likes that. And there's always this adage that the market is pricing in. So maybe that the market knew that the Fed or expected that the Fed was going to raise rates. They did so. But then why would the market go up so much if that was already priced in? So as you can see, as a professional that's been in this business 18 years, you can't even make sense of why the market did what it did based off of the headlines, because you could have had a completely opposite reaction be the story you believe was going to happen, and it could have sounded right. So why share all this? Because you can't try to predict what the market's going to do and play games with your portfolio in anticipation. Or if you are, you've got to be watching it all the time. You basically have to be day trading, which we know is not necessarily the best way to manage your investments. And you got to be getting in and out really quickly. But if you get the bet wrong, you bail and you don't sit with it. Most of us don't have the time. Most of us don't have the expertise, and we don't need to be doing that. We just need to have a portfolio that helps us accomplish our goals. And historically, and if you have belief in the system and faith, that expectations are the market should continue to do what it's done over history for the long term. So why try to play all these games? Why react to headlines? Have it diversified, have it long term, have the money you need in the short term, as we're seeing this year, not in the market. Don't take on too much risk. Understand where you're investing, and then don't worry about the headlines. Really, the only reason I do this podcast is because I know you hear these headlines, and I want to try to make them make sense. So how do you digest this? How could it? Why are people talking about it? And then ultimately, how does it impact you? And 9 times out of 10, it's not impacting you in your moment or your plans for the future. So it ends up just being a distraction. So anyways, got a little bit of a soapbox and on a tangent. Back to the headlines. I mentioned a little bit, but the markets like that. So we ended July, the best month since 2020, which I hate those headlines, the best month, the worst month, the best day since, and it's usually not that far gone. So we had a good month, but that's coming off of a rough year. So we're still down on the markets. This just goes back to the value of staying diversified, not trying to make changes. July was good. August could be crummy. We don't know. So trying to move in and out is a tough thing to do. Not to say that you can't, not to say there aren't people who are doing it, and not to say that you shouldn't make tweaks along the way. Just do it with purpose, do it with some consulting with somebody to help you talk through it, and do it so that it is working towards your goals and working with your plan. So July was good. We'll see what happens from there. The other benefit is you think about, while these down months, let's just say we did hit the bottom and we are on our way back up. Those of you that kept on investing during the scary times of the market being down, you were buying everything on sale. So you were dollar cost averaging in, taking advantage. We never know again when the ups and downs are going to come. So that's why dollar cost averaging is such a loved practice in the profession, because trying to put it in the market, timing it perfectly is hard to do. And even if you tried to time it and put all of your money in during the decline, because the market's down so much, the psychology of money is going to make you afraid to do it because you think it's going to go further. So dollar cost averaging has helped out this year. You really won't notice the impact until maybe next year or beyond, but it's the benefit of investing. All right, so this is the headline I want to spend a little bit more time on from a mindset. So the Wall Street Journal reported that banks are seeing that rich Americans keep borrowing, defying economic gloom. So there's a blog post down below called What Recession by Jack Rains. He's one of my favorite writers. Young Money is the name of his newsletter. And he just talks about how you hear all the news and the headlines and the data that suggests a recession. And he's talking about his night out in, I think it was Atlanta. The Braves game was sold out. The coffee shop is filled. The baristas are busy all day long. And, the reality does not necessarily look like a recession despite the data. So I really like that. But what I want to get to on this part of the weekend review video is the mindset. So yes, the rich get richer. This is one of the reasons they're able to do that. They have enough assets that they don't have to borrow on normal terms, or they don't have to sell their investments to go make another investment. They can borrow against it. I don't want to get into, is that fair, is that not? I think one thing is that should be something we should all strive to be in a position to do. So rather than complain that the rich get richer because they have these unique things, put ourselves in that position to be able to do that. Yes, I know if we could all snap our fingers and be rich, we would. It's not that easy, but if you never allow yourself to believe you can do that you can grow your net worth, your assets, your career to have that, then you're never going to be able to do it. So the first thing is make that a goal. There's nothing wrong with wanting to make more money. There's nothing wrong with wanting to acquire wealth as long as it's for the right reasons. So let that be a goal of yours, is I want to be in a position to be able to borrow against my investments in the next recession so I can take advantage of investments on sale, businesses on sale, real estate on sale, whatever it may be. So one, the mindset behind it is don't be mad that people are able to do that. Figure out how you can do it as well. And it's not going to necessarily be easy, but you got to believe that you can do it before you even have a chance. So that's reason one I want to talk about the mindset. The second thing is opportunity. Many of you, because I'm not, but many of us are looking at right now as a negative. Recession's coming, bad things are coming, inflation's going up, interest rates are higher, just doom and gloom. The things are going to be horrible. This is the beginning of the end of America. If you listen to the headlines out there, those headlines are meant to drive you to watch and listen to sell advertising. So remember that. But those that have been through this before, those with the greatest wealth, know that during these slowdowns, which are normal, go look at the business cycle, during these slowdowns is when the greatest opportunities are there. Whether it's opportunity to buy assets that are distressed, whether the opportunity to start new businesses as other businesses go out, this is when the people with the greatest wealth make even more money. You may not be able to go out and buy a new business, but in this downturn, rather than looking at it through the lens of a victim or through a negative landscape, what are the opportunities that are going to present themselves for you in this? Is there the opportunity to position yourself to be more indispensable at work? Is there the opportunity for you to take a risk and start a new business? Yes, financial planning is going to be a big part of this. Don't run out and just go take these risks. Don't just go out and do things, but think this way. Think about, all right, if things were to get worse, which maybe they don't, I don't know, but if things got worse, what are the opportunities that are unique to you? What are the opportunities unique to me that I can capitalize on, that when we come out of this, and we will come out of this, that will position you and us in a better spot? So these rich folks who have the money to go out and do it are not looking at how do I protect my investments, I need to get out of the market. It's how do I leverage what I have to go take advantage of the other people's that are getting scared, that are selling their investments, that weren't properly prepared to make it through a downturn of the business and have to sell their business to get out. It's not greedy to be in a position to take advantage of that. In some respects, it's saving some jobs. If somebody's in a position to buy a business that's failing, then those people who work at that business still have a job, rather than the business closes, they're unemployed. So I think greed is something I want to talk about over on Pursuit that will tie into this over here. I think some of the things that we're taught is greedy and are greedy are not necessarily greedy, but it keeps us with a little bit more blinders on. When you look at, okay, I have the opportunity to do these things, here's the good that comes from this opportunity, it's not a bad thing. So growing your wealth, wanting to be able to get enough investments and assets to do this type of investing, to this type of borrowing, is not greedy. And being able to be opportunistic when things are more in your favor because you're prepared is not greedy. It's not a bad thing. So I really wanted to hit on this, not so much to talk about it's unfair that they're able to do this. That's the rules. So if that's the rules, how do we put ourselves in a position to be able to do that as well? How do we save and invest to be able to do that? Compound interest, starting early, building out a financial plan, all those great things. So I wanted to talk more about the mindset because I think the mindset is so powerful, and the mindset is something that we have control over. All right, end rant. Final thing, super short. Powerball ticket. One ticket won $1.337 billion. Hey, Silas, what would you do if you won $1.4 billion? If you had all that money, what would you buy? First thing. I know what you're going to say. What would it be?
A turtle.
A turtle. So he wins $1.4 billion. We're not telling anybody. We're talking to tax attorneys, and he's going to buy a turtle. All right. Before I let everybody go, you want to say bye to him real quick?
Bye.
All right. So the final thing is, in Ohio, single ticket, won the $1.3 billion Powerball. Somebody's life has changed. Congrats to them. The rest of us, we got to go back to work. We got to keep on building. We got to keep on creating, as I'm talking about over on Pursuit, and go after the lives that we really want, because that's not going to happen for most of us. But we can create our own lotteries through our actions, our work, our perseverance, and going through. So, anyways, that was the final thing. So Silas coming in, it was perfect timing. All right. So thanks for tuning in as always. If you're over on YouTube, give us a subscribe. If the conversation about the mindset with the article about the rich borrowing is interesting to you, head on over to pursuit.co. That's PRST.co. Pursuit stands for passion, relationship, self, and time. A little brand that I started. A lot more content over there about mindset and pursuing the life that you want. There's going to be all about your Benjamin's kind of influence on there. You'll see some Pursuit influence over here as well. And RLS Wealth kind of connects it all. So if you're interested in pursuing the life that you want, passion is the way to do it. I think creativity, being a creator, letting it out, helps guide you that way as well. Check that content out because it's a little bit different than what you're getting here over on All About Your Benjamins. Thanks for tuning in. Like, share, subscribe, all that great stuff. Have a great day. Happy birthday again to Roman, and we'll see you all in the next episode.